Thanks very much to those of you joining, and some familiar faces. Ginny, thank you very much for joining. Good to see you. Kieran, thanks. So this is an overview of our approach to a session on pricing. As I'm fond of saying, leg bone connected to the ankle bone. Often when we have people come to Wenter and ask questions, and I'm sure it's the same for you, Ginny and Mel, are there any grants? We say, well, yeah, there might be, and we can maybe help you with that. But what it does prompt is a question in our minds, which is, maybe we need to have a chat about, is there a desperate need for a grant, or is it a nice to have? And in which case we need to be talking about business development, and we need to be talking about marketing, and we need to be talking about pricing. And if there's particularly a cash flow concern, then what's at the heart of that is this particular area. Now, those who haven't seen my session before, when I've been doing them from time to time, the approach is I don't do death by PowerPoint. I don't read word for word. I'll let you read that, and I'll shut up for a sec, let you read it, and then I'll provide an overview. So I was mentioning in the Managing Growth session this morning, the overview about something called the thirds rule. If you're unfamiliar with that, what it relates to is essentially a third of your profit, whether you're a sole trader, limited, partnership, will go in tax if you're profitable above the thresholds. A third is for you. Well done. And a third is to reinvest before the end of the trading year, otherwise you'll pay tax on it, into scaling your venture. And what's going to help with that is having the margins. What we do in the sessions and also in one-to-one sessions is explore that literally by screen share and spreadsheets, and looking at what the cost base is, looking at sales forecasting. Whilst there is a way to be able to determine a break-even point for a venture for 12 months, what we focus on in the pricing webinar is actually trying to find the break-even point per unit or per hour, depending on whether the person has a service venture or whether they have goods that they are selling. This is just an overview. In this particular session, we're not going to go through the whole of the pricing webinar content or what we talk about in sessions, but I'm going to give you an overview. So most ventures in our experience, frankly, don't hit the thirds rule. Most are 50-50, probably 50% for themselves, 50% for tax, and then they come bang on our door and say, have you got any grants? So we'll let you know when there's grants. It does mean that it's about the vigilance with that and monitoring things. And of course, what most ventures are looking to do is increase their sales, increase their revenues. In a social enterprise context, it's the surplus really. I always think this phrase "not for profit" is such a misnomer. You're supposed to make one as a charity. This is what you do with it that counts. And so ways to increase revenue. Well, the obvious one is increase the number of customers. Yeah, would that was a lot easier than it seems to be for all of us. But it's the way to be doing it. Again, book in on a session with us, and we'll chat that through with you. The average transaction size, what's sometimes known as the average basket value or order value, if you've got an online venture. And so that's in a sense sort of the upselling a little bit and cross-selling on other things that you might do. Not just your core offering. The touch points, the number of times that you are engaging with clientele, is it just a high value, high ticket item that's only once a year that might take you 2 years to pull off? If you're in a business to business context, it varies obviously from sector to sector and venture to venture, but finding ways to increase the frequency of transactions is another way to boost it. And then there is increasing prices. Now, That's rather a raw and hot topic these days. If we think about the cost of living crisis and particular dynamics that operate in certain sectors, it's not a blanket thing to say, right, jack your prices and everything's sorted. Of course, it's far from that simple. It may be that there are some things you can do where there's a tolerance there in the marketplace for an increase, but on one or two things, maybe, but not everything that you do. And what we like to do is just, say to you repeatedly, book in. It's a free service, okay? Talk to Ginny, talk to Mel at Stanta. Please go and chat to Kieran. Please go and chat to Steve. Come and chat to us at Wenta. It's what we're here for, okay? Now, in terms of pricing models, there are different ways to go about this. There's market forces, whatever the customer's prepared to pay. There is competitive, which is a fairly common one for people. In larger ventures, economies of scale, it's more cost effective basically to build two instead of one. And that applies in those cases. For far smaller ventures, economies of scale is not really the way to be looking at it. A common thing these days is things like software as a service, subscription-based, tiered premium, and we can chat to you about getting that at a level that's going to make sense for you. And I'll give you a little bit of an overview of that in a moment. Where we tend to start, though, is the one that the accountants prefer, the bean counters, who are a very cautious bunch. And we're all in the business support community. We are all about risk management, and creative entrepreneurial people. Yeah, crack on. Fiercely independent thinking, perfectionists, fly by the seat of the pants, and that's great. But there comes a point, particularly if you're going to be talking to investors, if you're going to be talking to financiers, lenders, grant sources, they're going to want to know, how did you get to your pricing? And it's great if you can do the evidence-based stuff. Rather than a sense of, well, they're charging X and I'll charge Y, because you don't know what's going to happen if it gets into a pricing war. So where I would like to show you a specific in this session is cost plus pricing for a service-based business. And there is a calculation, there is actually a formula. So I'll give you some figures in a moment. So we'll do a working example. And this means breaking out the spreadsheet and the calculator and the abacus. And what it means is working out the costs for a venture for 12 months, which we're here to help you do. And the idea is to factor in, what do you want out of this business and venture to contribute to your lifestyle choice? Looking at it, if you're very early days, looking at it at aspirational, okay, what do you want? And then looking at, if you're an established venture, well, that's a little easier for you because you've maybe got 12 months worth of trading history and you've got a kind of a bead on where you're at, but also thinking through what sort of expenses might you have in the next 12 months that's different from the preceding 12 months. When we work that out, you're then going to divide that figure by what's called fee earning hours, or productive hours as they're known. Now, you attending today's event, that's work. Okay, but it's not fee earning per se. Okay, you doing your admin, you doing your social media posting, to a certain extent, we might say the social media is maybe fee earning, but it's time spent with your client, with your customer, with your service user, with your beneficiary. Okay, that's the fee earning, that's the productive stuff. And when we divide that, it gives us a break-even rate per hour for a service-based business. So I'm going to show you a formula now with the figures. I'll let you absorb that for a second, and then I'll clarify. Now, if we were to assume the top figure, 45,000 for the year, let's say that as a bare minimum, the owner wants to take, the founder, the owner manager, and net 25,000 for themselves, okay, to contribute to their own lifestyle. And then we've got 20,000 is their running costs, okay, initially for the year. So that's running a vehicle, it's marketing, it's web hosting, insurances, the usual common or garden, okay. 45,000 then for the year would be the figure. If we were to say 6 hours per day is fee earning time, 5 days a week, 48 weeks of the year, that adds up to 1,440 hours. So 45,000 divided by 1440 gives a break-even rate of 31.25 an hour. Now, there's no profit on that. That's just covered the basics. Remember, there's a tax bill on the 25K. And remember, you're looking at the third rule, which is enough to reinvest in your venture before the end of the trading year. In other words, what we're saying is it's probable that you'd need to be at least, as a bare minimum, 33% higher, but let's say double, possibly even you want to go higher than that. You could be at £60 an hour to make your business viable. It might even be higher, £75 an hour. Now, if you're in the kind of marketplace where the going rate is £250 an hour, terrific. If you're in a marketplace where the going rate is £25 an hour, we need a conversation. Okay, and this cuts to the heart of basic viability. Now, another way to look at this is, I won't do the show you on screen with the maths, but if you want to work this out for yourselves, let's imagine the top line is a bit higher. Okay, let's assume the top line is 94,000. And you can break out the calculator if you want to do this. But instead, what we've got, instead of one person fee earning, what we've got is 3 people as fee earners. And for the sake of simplicity, we're going to assume that they do the same hours that you do. It won't always be that way. Okay. And it could be a business development person. It could be, let's say, if you've got a training company, somebody delivering for you online or offline or both. But it would be 3 times 1440, which would give you 4,320 hours. So 94 would be the top line. 4,320 would be the bottom line, below the line. And that would give a break-even rate of £21.76 an hour. In other words, it's a fundamental reason why we employ people. The more that you've got as fee earners in scaling a venture, even though you're looking at the top line and thinking, how can I afford to pay those people when I can't afford to pay myself? But at the moment, you're probably costing your business £50, £60 an hour, and it then becomes more cost effective to pay somebody else to do the same work, frontline do the do, at a lower rate than you are. And so I'm hoping that's clear for you. If you're not, book a session and we'll go through it with your figures. Okay. Now, for those with a product-based venture, I'm not going to go through the whole full thing today. Please book in, but I'm going to show you the calculation, which is slightly different. And this is where we take, remember before we said the annual overheads, everything lumped in all in together. Now what we're going to do is separate those out into 2 piles. So the fixed costs stay the same no matter how busy you are. So if you've got premises that you rent, I don't mean at home, I'm talking about managed workspace or lease premises. Your rent stays the same through the year. Salaries stay the same for staff. Insurances, you know, that we'd probably allocate, you know, other top line stuff in there, marketing maybe, divided by direct costs. Direct costs vary according to how busy you are. It's your products, it's just your stock, your inventory. Okay. It would include also things like payment processing charges that vary according to how busy you are. When you've got that figure, divide by 100, gives you a ratio of one to the other. Let's say it was 60%, one to the other. In a product-based business, the ratio will probably be quite close to 50 or so percent, whereas in a service business, it would not be that way because you haven't got the costs of the variable costs. But what that is a contribution then per item that you sell. So if you sell an item at £5, let's say, each, it costs you £5. Sorry, let me rephrase that. It costs you £5 to produce it ready for sale, including packaging, okay, including your payment processing fees. If the ratio was 60% from this calculation, you'd multiply the £5 by the 60%, and the result you'd add on to get to your break-even point for that item. Now, if you were to sell that item at £6 with a 60% ratio, you'd be making a loss. If you were selling the item for £25, probability is you'd be making a profit on it. But if you then came to discounting at any point, you'd need to know where your break-even is per item. And that's where a lot of businesses fall over. Now, what you're going to do when you've got your true break-even point is you then got your markup to get to your selling price. And here again is we find quite a lot that there's a confusion in people's minds between what markup is and what margin is. And so you'll be getting a copy of this. What I'm going to do is show you a comparable table, okay, between markup and margin and what happens, because we see this a lot when we're looking at people's cash flow forecasts, their profit and loss forecasts, and their actuals. When we're looking at it over the previous 12 months, we can see where there's an issue. So to calculate markup and to calculate margin, here's how you do it. Now, if you're in a service business, you may have seen this expressed as cost of sales, whereas if you're in a product business, you'll know it as cost of goods sold. And it's the gross profit. So in other words, sales minus your direct costs, okay, to get to your gross profit, divided by the cost of sales, that's the direct costs, times 100. That's to find the markup. To calculate margin, it's sales minus the cost of sales or cost of goods sold. And then you're going to divide that by your sales figure to get your margin. Now I'm going to show you a conversion chart to show the difference, what it means. Now, for some of you, you may be in the supply chain. Okay, business to business, you may be doing wholesale distribution or looking to deploy. Let's say you're a manufacturer and you're looking to deploy a distributor or a manufacturer to get to the retailers or consumers direct, B2C. And let's say the distributor comes to you and says, you know, well, what's my margin? And you might be thinking in terms of markup, or you might be thinking in terms of margin and confusing your percentages. Because what it means is if you've marked up by 50%, your margin is 33%. That's what you've got to play with. And this is a critical thing now, but more so nowadays. I mean, it does happen during downturns in the economy. I mean, you can see the gray hair. I've lived through 4 of them and I've had businesses in 3 of them. You know, at what point do you start to think that there's some concessionary approaches you can take here? Let me give you a tip. Price correlates with value. And an important consideration is, unless you are in the discount game, don't devalue your brand or your offering. Okay, because it's so much harder going into your marketplace on that basis. There's plenty of reasons why you can justify price. Why do people buy Range Rovers when, you know, any other brand can do the same job functionality wise? Okay, because it's linked to value, people's perception. And that's psychology, not maths. So the way to do that, to justify pricing, is around adding value. And that's why Wenter and Stanta and the Growth Hub and the LEP focus on the support for you, okay, around how to get a combination of a competitive edge and a collaborative edge. Sometimes partnering up is the way to do it. Don't see it as competition always. And you focus on the value add. So if you think about thanks very much. With apologies to those on group 2. Note to self, Michael.
Did you overrun?
Keeping timings, yeah, just slightly. I'm just going to finish off to group 2 actually, because we've got to a really exciting point, which is about adding value. So for those of you who went to the other one on websites, well done, Burps. Thanks, Burps. Just to say, for those who are wondering what the pricing one was about, if you're thinking about price led and discounting, the thing you want to be very mindful of is adding value. Okay, value in people's minds is the perception that allows you to create an offer where price is no longer the consideration. It's a tricky thing to get right. If it was that easy to get right, we'd all be doing it. Book a session, come and have a chat with us. Glad to take you through more of it.